Hello, folks. Welcome to this special episode. We will talk about the magic of outperforming on the downside. Now, this has a double negative to it. So, essentially, what we're saying is when the markets are going down, you could be still outperforming the market. So, you also may be coming down with the market, but you may be doing better than the market, and hence you are outperforming the market on the downside. And this part of the entire thesis is never focused upon by most investors. And if you really understand this concept today, I think it will add an element of magic in your entire investing journey. I can guarantee you that. So let's start with understanding what is max drawdown and what is current drawdown. So drawdown is nothing but how far from the top do we drop the most within a period of time. Let's say Nifty went maximum to 24,000, then it drops to 20,000, and then it recovers back to 24,000. So the max drawdown here would be 4,000 points, or 4,000 divided by 24,000 is the max drawdown. Current drawdown will be, there could have been drawdowns earlier. In the very recent event now, after the previous drawdowns have been covered, what is the current drawdown? We'll take an example and you can see this. Let's say we start with a capital of rupees 100, and in the first year we get 100% return. Starting capital is 100, ending capital is 200. So we've made this table here where first year start capital is 100, end capital is 200, profit is 100, returns in that year is 100, max drawdown. So right now there is no drawdown. You are at the maximum position of your portfolio. Current drawdown is also zero. Absolute return is 100%. CAGR is 100% right now. Next year, what happens is that there is a slowdown in the market. From 200, you come to, let's say, 150. Okay. Now what is happening? Your starting capital was 200 from the previous year. Your end capital is now 150. You've lost 50 rupees this year. The returns in this year are 25%, going from 200 to 150. The maximum drawdown is 25%. That is the maximum you have come down from the top. And the current drawdown is also 25%. Absolute returns so far is 50%. You started at 100 and now you are at 150. CAGR is 22.5%. Actually, it should be 22.5%. That is fine. Okay. Now, year three, the capital goes from, let's say, 150 to 250. So in year three, what has happened? You've gone from 150 to 250. Profit this year is 100. Return in this year is 67%. Max drawdown is what has happened till date. What is the maximum that has happened? That is 25%, even though our capital has recovered. And current drawdown is now zero because there is no drawdown. We are at the max position of our capital, 100 going to 250. But in that journey, we've had a 20 drawdown. So the current drawdown is zero, max drawdown is 25%, absolute returns till date is 150%, CAGR is 35%. Let's go forward. Next year again, let's say we go from 250 to 200, there is a slowdown. So 250 going to 200, you lose 50. There's a 20% returns of negative returns this year. Max drawdown is now again minus 25%. We've not exceeded that. The current drawdown is now 20%, which is the loss that we've seen from the recent highs of minus 20%. Absolute returns from the very beginning are 100%. CAGR over 4 years is 18.9%. And let's say fifth year, you go from 200 to 350 rupees this year, 75% gain for that year. Max drawdown remains 25%. Current drawdown is zero because you've come back to the highest point. Absolute returns are 250% because you've gone from 100 to 350, and CAGR is 28.5%. So I hope you have understood now what is current drawdown and what is max drawdown right here. Now the problem with drawdowns. Uh, let's take an example. Let's say you are running on the road and you fall in a ditch. If the ditch is 5 feet deep, you still have a chance to get out of it. You'll brush yourself off and start running again or walking again. But if the ditch is 15 feet deep, you will have extreme difficulty in coming out. You will need external help. Uh, Maybe there is no help coming. You may just not survive that. So that is the difference between the depth of the fall that you have, if I may say so. So now let's look at, if you have a fall of 10%, you need 11.1% gain to come back to even. If you have a 20% fall, you need a 25% gain to come back to even. If you have a 30% fall, you need 42.9%. If you have a 40% fall, you need 66.7%. If you have a 50% fall, you need to double your money from that point to come back to your even point. If you have a 60% fall, it is 150%, and a 70% fall, which happens a lot of times in stocks, you need a 233% gain to come back to your original capital. I'm not even counting the opportunity loss that has happened during this. So this is the math behind the returns to break even. Now, let's take another example of two strategies, exactly same performance on the upside, but different drawdowns. So let's say strategy A, first year it went from, let's say, 100 to 200. Strategy B also went 100 to 200. In the second year, strategy A lost only 25%. So it went from 250 to 150. Strategy B lost only 12.5%. So it went from 200 to 175. Third year was again the same for both, 50% gain. Strategy went from 150 to 225. Here 50% gain, strategy went from 175 to 262.5. So in the 3 years, these two strategies were compared. First year was same, third year was same. The only difference was in the down year of second year. What is the ultimate result of that? Overall, 100 becomes 225 here, and here in strategy B, 100 becomes 262.5. Can you see the difference now between these two strategies? Only coming because you fell less in the second strategy right here. So if I were to uh, see it on a real live basis during COVID. So this is going to have a very real example for you, that let's say between uh, March Feb 19 to December 2021, these are two strategies. Okay, these are actually real strategies, but I am not naming them. So now what happens is that up till February 2020, they are both the same. Now, one strategy loses 40%, strategy B, and strategy A loses, let's say, 20%. Okay, in the downfall. So the COVID fall came, one fell 40%, one fell 20%, and post that, the returns for both strategies are the same. Okay, what is the end result? Strategy A goes from 100 to 342, strategy B is at 257. That is the kind of remarkable return difference that will happen because you forced your strategy, if you could, to fall less. So if you fall less in the next period of your jump, you will jump much higher because your base is higher. Again, coming back to this slide so that you can understand this completely. Yeah, this one. So again, if you were falling less, you only needed 25%. If you fell 20%, you needed only 25% to come back. But if you were falling 50%, you needed 100% to come back. So the deeper you fall in your portfolio, the more difficult it is to come back, not only to your base capital, but to your gaining position. And that is the reason why cutting losses early is extremely important. Having a strategy that gets out of losers early is very important. There are two concepts to this. So you are outperforming, let's say the market is going up, you are outperforming while the market is going up. That is fine. When the market is coming down, if you are able to outperform the market, then also, then the two outperformance together will really create magic for you. That is what we have seen in the past, that it is not just outperformance while you're going up. In fact, I would go to the extent and say, when the market is going up, if you are making market returns, good enough. When the market is coming down, if you can beat the market by not falling as much, you've actually beaten the market overall. So outperformance during an uptrend is not the only parameter one should see. How portfolio reacts during a market fall, market correction is key to a sustained success. When you bring these two powerful concepts together, that is when the magic gets created. Please let me know how you like this concept. If you have faced this in your own portfolios, if you have had a deep drawdown, how did you manage to get out of it? And if you, over the period of years of your investing, if you've seen the period where you've had low or shallow drawdowns, you would have sprung back very, very quickly and made huge returns. I'll be happy to see more comments from you on this subject. Thanks. Bye.